Hello everyone, welcome to the Torin Dove Financial Channel. Today I'm talking about a subject that is very near and dear to my heart, and that is holding periods, and specifically kind of attacking the short-term get-rich-quick mindset that has become investing for the majority of average investors today. Now, the average holding time in the 1950s, surprisingly enough, was 8 years. Now, this boils down to a lot of factors. I mean, you had, of course, paper certificates. It was a lot harder to do frequent transactions compared to now where everything's electronic. But currently, the average holding time is almost 5 months. Now, this is, of course, going to have day traders involved. It's going to have people who have very, very short time horizons involved, and that can go into these statistics. But 5 months isn't enough time at all for you to actually value a company, find a good opportune price at which you can buy and accumulate shares of a high quality company, and then actually have an ownership stake in a business model. Instead, it's what you'd assume if you had electronic trading cards that you could just sell at any time for different values, which is how a lot of people at this point kind of view investing in stocks. It's almost like you have these tickers on a screen and you're just constantly trading and selling them. Now, I myself have not always been the best long-term investor, despite that being my objectives. From the time I was very young, I parked a large portion of my Roth IRA into the Vanguard S&P 500 ETF, and that's still my largest holding in my Roth IRA. But I would be completely lying to say at certain points I wasn't tempted to do more active trading, and I too kind of fell subject to the get-rich-quick mindset for a lot of people. You know, there are opportunities where I had days where I made $3,000 in a day, and you, especially when you're a young high school kid and you've parked all of the money you've ever made at working your first job or anything into the stock market, and you make $3,000 in a day, you have times where you're like, oh my goodness, this is how you're meant to invest. These people who just buy and hold on to things forever are complete and total idiots. They're morons. And you start out and you're on the top of the mount. You're like, I'm going to be the best day trader ever. This is super easy. And then reality hits you. I mean, for me, it was holding on to shares of a company that I frequently traded. Pre them splitting, they would range between $800 and then $1,000. It was a very volatile trading, and I was able to oftentimes acquire it at the $800 mark and then sell it towards the 1,000. And I just kind of banked on I would be okay waiting a week or 2 weeks and then making profit. And it was great for a while until the company reported earnings, and I had a large portion I had bought at $800. And if your time horizons, you're constantly in this 2 week cycle, you're like, great, 2 weeks from now, I'm going to make $600+ and it's going to be wonderful. And then earnings came out, the share price tanked, and I was stuck holding on to a company I knew very little about. Like, obviously, it's something that you would know the name of, and you're like, I know what they do, but on a deeper business model level, I couldn't walk through, like, anything to do with the company or even had an intrinsic value target at all. And it really tested my patience a lot, because here I am with not even basically caring what this company does. It's just a ticker on my phone, and I'm just able to every 2 weeks get a large sum of money by selling it and then buying it for much lower. And that's like such a simplistic thought process. I often will look back at that moment or reflect on that moment and just be absolutely ashamed of myself looking at like where I am now today. But I think a lot of people have to kind of make their own mistakes in order to learn. But for some people, hopefully you're able to learn from other people's mistakes and kind of build your own portfolio in a way that actually kind of works and improves upon this. You don't have to make the mistakes yourself of getting caught in a short-term mindset. I mean, when you look at the statistics of day trading and of trying to make money in the stock market that way, you're much better gambling. That's not a statement that someone should want to make about investing. This is a game where the odds, if you do it right, are heavily stacked in your favor. I mean, you just have to look at the asymmetric returns of it. At worst, the worst thing that can happen is you lose 100% of your money in that position. The returns, technically speaking, there's an infinite number that it could be. You can well over double your money on any one given position, especially when you're dealing with long-term investing. That's almost quite likely, especially if you're just parking it into an ETF that broadly tracks the market. I mean, you really only need a 15% annual return, and with the power of compounding, you have a position that doubles every 5 years. So overall, you're taking a game that's heavily stacked in your favor that you can win, and you're making it significantly harder to win, like exponentially harder to win at that game. And for a lot of people, damn near impossible. You're just not going to come out on top trying to day trade. So I kind of consistently on this channel try and like preach something, but I hadn't made like a full-blown video where I kind of combine some of these concepts together on how to actually kind of attack this get-rich-quick mindset that really plagues and ruins investment portfolios. I mean, if you just look at what the average retail investor does compared to the market, there's like a 6% gap there. That's a large number. And when you're plugging that in and considering compounding in the long term, you can leave hundreds of millions, or not hundreds of thousands of dollars. I mean, potentially hundreds of millions. Some of you might pick fields where you're making a ridiculous amount of money. Like, especially in today's world, that's not crazy to necessarily say. Like, you're in a game where small percentage points, like beating the market by 1% annually, doesn't sound like anything at all. And then when you look at it in the grand scheme of things, that adds a significant amount to your portfolio in reality. So underperforming 6%, you can only imagine how bad that actually goes for your portfolio and how much that can hurt you, that can slow down when you're able to retire, that can basically ruin your chances at financial freedom. Like, there are a lot of factors that go into that. So I always preach investing in your circle of confidence. Again, a lot of these ideas are things that I've learned and adapted from like the great investors themselves and what they preach. I think in a lot of ways, copying some of the like best people is how you're actually going to have a really, really good portfolio. Not necessarily like one of the apps where you can just like only have that great investor's portfolio, because then you don't know any of the positions and you don't have actual theses in place. But like, if somebody came to me today and said your whole life purpose is going to be playing professional basketball, it makes a lot more sense for me, instead of just going out and trying to like do things on my own and do what I think is necessary to improve. It makes a lot more sense to do research on what people who actually train these players, the players themselves do, their routines, their warm-ups, their practice drills, in that sense, and I'm probably going to have a lot better success doing that. Now, I'm not to say that going about it fully on your own isn't possible. I mean, there are going to be outliers of people who go about it on their own, and maybe they have a really, really, really incredible position that they got in super early and it becomes the next Microsoft. That's 100% possible, but those are outliers and those are very infrequent, and the statistics are it's not going to happen. So invest in your circle of confidence with companies you can easily get some type of valuation for, that are cheap. You can they're great companies, great compounders. The financial statements actually look good, and it's in an industry that you can kind of understand. I know some of the biggest hits in my portfolio have been related to gaming, and it's because I know like which of these companies make like quality games that people actually want. Like, there's a difference between looking at 3 financial statements and saying, okay, this company does significantly more in revenue. That means that they're a much better target than this company. But if this company is an indie team that puts together projects that are consistently really large hit successes compared to a company that consistently underperforms, especially when you consider how much they spend on games, you're much better in the indie company. And so there are things like that where I really like, I know the products well, they're everyday products I use, or they're products I'm like very familiar with. I kind of know how the business model works. I see people and I see their shopping habits, so I'll do stuff like that. Whereas if you kind of plop me down into an industry I don't really necessarily know a ton about, like healthcare, thankfully, luckily, I haven't had a lot of health concerns, and it's not something I like really necessarily know about from a consumer standpoint. So, like, if you want to kind of take the Peter Lynch approach of knowing the products you're investing in and knowing these companies, I don't necessarily know a lot, and I could put money in Eli Lilly or Novo or any of those, but at the end of the day, I'm waiting on FDA test results, and I don't really know necessarily enough about the players in that space. It's not something that like clicks. And you'll understand when you're investing in companies that just click to you. They just make sense. And that could be from past experiences or a lot of companies you've looked at. Like for me, something that kind of clicks is tech. Weirdly enough, I was a very technologically advanced child. I grew up in a house that kind of emphasized, like, I went to multiple coding camps and things of that nature. And so it's something that kind of just clicks where I know, like, which companies consistently put out good products, and that's like a good starting place if I want to evaluate companies in there. But there are industries I know absolutely nothing about and would be completely out of my depth of confidence, like, or circle of confidence, like biotech, like, just for instance. So invest in your circle of confidence. And then also in a similar thing, like, you don't have to know everything. There makes no sense in me if I know deep down that it's significantly harder for me to understand and comprehend companies in a certain sector. Just because a company's doing well in that sector doesn't mean I need to try and learn everything about that sector. If it's not clicking and it's not a strength, I'm not going to be able to make a substantial position and feel confident about it for the long term and feel good about management, because I don't really know what management would look like in a like elite company versus a poor company in that sector necessarily. So you don't have to know everything. Play to your strengths and you're going to create a great portfolio. Then you have avoiding the day-to-day. There's going to be a lot of things in the media. There's going to be a lot of the targeted ads you get on Instagram, which I absolutely hate, or X, or anything with targeted ads. I hate those ads so much. I'm not falling for your crypto scam. Please quit targeting me with those, or you're like, invest in this company that's not public yet, that's gonna be the next AI something something, keywords, hot words, all of that jazz. Don't fall for that, please. I'm begging you, do not throw money into crappy companies that have no chance of competing with established players already. Please. So next I have kind of avoiding IPOs. A lot of the great investors are very, very anti-IPOs. And I mean, it kind of makes sense. These are not, you're not going to get necessarily an incredible valuation at an IPO. I mean, certainly you might see returns in the very few days. Like a recent example would be Circle, but you're going to have to deal with a lockup period for 6 months. You're going to have to deal with the fact that it's a very new, very public company. It's going to be all over Yahoo Finance, Wall Street Journal, Bloomberg, and this is going to, of course, draw investors, which is good for, like, initially. But then towards the 6-month period, after you've waited that long, a lot of that hype may start to fade, and you're just stuck holding shares that you bought at a terrible valuation. Even if the company's incredible, you can still lose money. Like, even if it's a good investment at certain points, there's a strong likelihood that during the IPO process, you're going to have bought it at a horrible valuation, admittedly. Next, I think a really, really good practice to do in general would be setting your own expectations in terms of what you expect per year. It may, like, return wise, what your target return rate is. It makes no sense if you just going about investing and suddenly you're getting into it, you're very early, you don't even really know what to expect, and you saw that your savings rate was in your savings account was horrible, or you looked at a CD and you were like, man, 4% right now, I don't really want to do that. That doesn't sound like a lot of money. And so now you're trying to invest and you're like, I'm going to set a real, let's say just some out there number, like a 50% annual return, which is humanly possible. I mean, the amount of risk, and you'd have to dig into options and derivatives and make your process really, really complex and very risky, and it could blow up in a heartbeat, but it's possible. But if you set these outlandish expectations of, I'm going to do something that in the long run is really, really easy to get a 10% return per year, like that's just really simple, 8%. I know a lot of professional investors shoot for 15% return, and you do have to definitely take risk, and there's concentration that comes with that. But set realistic expectations for yourself, and you're gonna not necessarily, you're not gonna fall to the day to day. You're not gonna get into this grind set of, I need to make the most money right now, because you'll go chasing these short returns and you might miss out on building a really good position in a company that has great long-term growth prospects. So don't don't set your expectations unrealistically high and go chasing after these very short term returns that aren't going to be sustainable in the long run. Then we have utilizing patience. And I'm going to combine this with another one I have, which is going to be, it's okay to have cash at certain time frames. Now, obviously, when you get started investing, you might make some money initially, and you're going to have this thing of, why would I have any money in my portfolio not actively working for me at this specific time? It makes no sense. I'm working my money at all times, should work. But then you might end up buying at high valuations. You might end up timing things wrong. And if you're not concerned about timing at all, which I feel like is a slightly more advanced thing, then it's perfectly okay to just dollar cost average and throw this little tidbit like completely out there. Like, you can skip ahead in the video. But there are definitely going to be times where if you see high quality companies, like let's say you really, really want to invest in Nvidia, but it's at a high valuation right now, and there's crazy AI hype around it, but you know deep down that it's going to be a great company for years to come, and you've done your own financial research, and you love the management team, and it's really competent. Over the next 3 years, there are going to be plenty of buying opportunities in a company like Nvidia. I mean, basically in every company over the next 3 to 5 years, there are going to be great buying opportunities. Why would you make yourself take a significantly worse return, or potentially even a loss of some sort, when you can utilize patience, have some of your portfolio in cash? So if you have events that are market overreactions, or are things where everybody in the short term is panicking, but your time horizon's 40 plus years, or 30, or even 10 at points, why it doesn't make sense to, oh, I know I really love this company. I know it's going to do great things. I'm going to buy it at whatever valuation is out there. That's not a way that you're going to see long-term sustainable gains. That's a way that you might potentially see losses. And so just adapting a little bit of patience, understanding that it's okay to put a company on your watch list, and have a long watch list even of companies you know you really, really need to own in your portfolio and will help you diversify and everything like that. It's okay to wait for good opportune buying times. Next, we have invest appropriately for your time horizon. And what I mean by this is that you're going to have a lot of different goals in life. You're going to have a lot of different objectives. And it doesn't make sense to have 100% of your portfolio invested for just one of these goals if you're going to try and utilize your investments for other things. So, like, say you want to get married one day and it's going to cost you a lot of money, but also you want to retire. Your marriage is going to come up sooner. So, dedicating a certain portion of your portfolio to more short-term focused things that are going to be more like fixed income and things that are kind of guaranteed, some CDs, some bonds, things like that. It makes a lot more sense than investing everything with this idea that, oh, I'm not going to need any of this money for 40 years. I'm just going to park it all in stocks, because there have been time frames where, like, you have like the lost decade or a horrible 5 years, and then you would have been much better off like splitting up and portioning and planning for those things that are coming down the road. So be mindful of that. If you have anything that your major plan is, oh, I'm going to need this money in a couple years and I'm going to take it from this, then maybe set aside inside of your portfolio, like maybe the amount you're going to need, and set it into a bit of a like CD or bond ladder. And you'll be much better off than hoping you can time selling everything in your equities portion in a way that doesn't necessarily lock in losses and doesn't necessarily really hurt your returns and everything like that. So invest appropriately across the entirety of your portfolio if you're going to be utilizing that portfolio. Now, obviously, if it's just, oh, this is only going to be for my retirement, so setting up a Roth or a different account even for things that are only going to be for retirement, then invest the entire portfolio appropriately. Next, avoid hype. Again, there's going to be a focus to try and get you to act. And really, this is just something that it's like missing out. You're watching people. They're going to be like, you're going to be a serious investor. There are going to be years where the markets aren't necessarily doing incredible and no one's talking about stocks at all because they're all focused on some TV show that's going on or like some world event that's going on, and you're really like still focused on stocks. And then suddenly these absolute buffoons who don't actually make good financial decisions are going to make more money than you. It could happen. They'll be like, oh my goodness, I heard about this incredible AI supercomputer company, bunch of keywords that also invest in Bitcoin, just like something outlandish, and I got a 700% return this year, and I'm a genius. And you're going to have to deal with that. You're going to have to look and be like, instead of going, damn, I need to invest in this company now when it's probably about to go, pew! Instead of that, you need to be able to understand that people can't, like, there are beginners who will make significant money by doing dumb, risky investments that sometimes pay off and sometimes blow up in their face. And then that's a whole other thing where you'll have to deal with the stock market's rigged, it's terrible, oh my god, I lost all my money in fucking China technology boom or whatever, and you're gonna have to deal with that. So understand that it's a two-way street, and avoiding hype, especially something I typically do, and this might just be me not trusting people a lot, is if there's somebody I deep down know doesn't know like anything about investments and they're pitching me a stock, I don't invest in it. I'll just be 100% honest. You gotta adopt the, yeah, that sounds cool. Oh, really? They're working on that? Oh, yeah, I see their website that's just a glorified PowerPoint they probably paid some 20-year-old to do. Yeah, that's awesome. That's awesome. You're going to save yourself a lot of money. You're going to save yourself some enjoyment for in 3 months when it blows up and they're like, oh my goodness, I lost so much money. Did you? And you'll be like, oh no, I did some due diligence and I really looked in and evaluated this company. I just didn't think it was the right fit for me, unfortunately. And it's going to be a lot better for you in the long run. So avoid hype. Don't take financial advice from people who you deep down know are significantly worse at investing and make terrible financial decisions. Like if you had a doctor who the survival rate of their patients was 20% and they were like, hey, we need to get you a routine surgery, you're not going to go to that doctor because they're terrible at what they do and they're not competent. And you're not going to go to some friend who's like not trained at all and is like, hey, I did this surgery on myself and it worked out and I didn't die, so I can do this on you. No, you can't. Adopt that mentality. And it might sound kind of mean and bad because they're going to be family members, they're going to be other people in your life, and it's going to sound mean at the time. You don't have to outright bash their idea. I mean, you can give them a little bit of a nudge and be like, hey, so like they haven't earned anything, and you got this from an email recommendation from a email that says at iCloud.com with a bunch of letters as the username and letters and numbers and all that jazz, and are you sure that this is necessarily the best fit for you? Like, you can kind of try and push them in that direction, but just because they're people you respect outside, they might be brilliant at what they do and be horrible at finance. And if you want a really, really good example, just look at Sir Isaac Newton's investment track record. It's a great time to just dive down a wormhole on the internet. It'll give you a fun laugh, but it shows that people can be geniuses, they can be bright, they can be some of the greatest thinkers of our time, and that doesn't mean they can transfer it over to finance and investments. Next, this is going to be kind of managing your own portfolio and a little bit of advice that you can kind of adopt, and just some strategies that I myself use that have really helped with having a long term approach and not kind of falling for the day to day. And that's understand the quality of each of your positions, and then actually having a portion, or even in my case, a separate portfolio for speculative positions. So for understanding the quality, kind of something that I adopted and I use frequently and I really like it, is I could give it a scorecard. So each position in my portfolio, I do it quite simply. I do it on a 1 to 10. 1 being, of course, horrible, you need to sell it instantly, you're going to lose all your money, and 10 being, I'm never ever going to sell this thing ever. And you should be really stringent on 10s, I'm going to be honest, but that's a different thing. So I go through each position and I kind of adopt, okay, so does it have a strong management team? Did I get it at a great cost basis? Are there future growth prospects? Is this a company that I feel comfortable owning 5 to 10 years? If I could never check the stock price again, is this a business model I would want to be involved in? And I go through like a really comprehensive checklist, and then I assign a score to it. And so if I have companies in my portfolio that are 8s, 9s, and 10s, especially, we'll use 9, it's a really example or a simple example. If I have a company that I know deep down is a 9, held it for years, understand their management team, anytime there's like a earnings release or anything, they're always saying things that I'd like to hear, and they take actions to it, and I feel like they're being led in the right way, and this is a business model I absolutely love and want to be involved with for the long term. I'm not going to see a bunch of 8s, 7s, 10s. Well, I mean, a potential 10 that you don't really know, but like everything checks out. And I'm not going to just instantly sell what I know is a guaranteed 9 for a more speculative position that on paper I'm like, okay, this could really explode, but you don't know that. You don't know that, where you have a proven track record in your portfolio already. So if you kind of adopt a scorecard approach, it's going to make you significantly like think through the process a lot more in terms of the criteria that a company needs to present to you in order to replace something that's already in your portfolio. And this is an approach that has definitely really helped me. There have been actually significantly less times that I've looked at companies and been like, okay, I have this company in my portfolio that I don't necessarily believe is an 8, and here's a company that I strongly, after doing a month-long deep dive into, strongly believe is going to be a 9 and is going to maintain that place or even potentially improve and jump up. Then I'll make the switch. But I don't frequently look at companies that are just out there and try and bid on everything and constantly have a bunch of turnover in my portfolio. So understanding that is really going to help you moving forward, especially when you're trying to accumulate a long-term focused portfolio. And then there's going to be times where, so for me, it's like, for instance, I had a certain portion of my portfolio that I wanted to have in, not necessarily speculative, but what's become the microcap mania series I've been doing was at one point a portion of my portfolio. And I'd been on the fence or not of making a separate brokerage account initially, which I should have done from the beginning, and we'll get a bit into that. But I wanted to dedicate a certain portion of my portfolio to some things that over the long term could potentially become 100 baggers, higher, something that would really be fun for me to look at. And I loved evaluating microcaps because there was a lot less research done by analysts. There was it felt more like a fun game of trying to like find thing like the needle in the haystack, and I thought that was really fun for me. But what ended up happening is that kind of overtook my portfolio because you have a lot of positions in that are going to at certain points like double in a very short time frame, or could lose a significant quantity of money in a short time frame and explode. And it's just, it can be addicting. And so dedicating a certain, like, putting that into a separate brokerage account was a must have for me, because I found myself like taking these positions in high quality business models that I felt very competent with and I wanted to be long term, and kind of falling into the habit of, oh, but if I sell a few of these shares, I can then buy more of XYZ Corp that's absolutely exploded and almost tripled since I acquired it less than a year ago. Why wouldn't I just go that route? And again, it's okay to have companies like that, but I think you're going to be much better off doing that in a separate portfolio, so then you're not tempted to sell or dig into these positions that are going to be high quality and you know are guaranteed high quality. They have moats already, they're able to fend off all of their competitors, they have strong balance sheets, all of that. So this was a bit of a longer rant video. I hope you guys kind of enjoyed this format. Again, I've said many times these are some of the most fun videos for me to make, where I just kind of get to yap about things I'm passionate about. Hopefully I had some points that you found interesting. Hopefully you might have learned something. And then if you didn't, hopefully it was just kind of like some confirmation that you needed to do the right actions and invest in the long term and really seek financial freedom, and not necessarily fall into the gamification, get rich quick that has been pushed onto us by Wall Street and a lot of the different firms recently. So thank you again so much for checking out today's video. I really appreciate it. I hope you have a good rest of your day, and thank you very much.